Good morning, investors and traders all around the world. If it's Thursday, it's Jobless Claims Thursday, but this Thursday we also have an all too important consumer price index report. Um, Wanted to give kind of an update of where we are as we've exited the month of September for investors, which was a extremely weak September. Usually September is a weak part of the trading year, but this one was exceptionally weak. So kind of also want to give some of our YouTube members, fans of the channel, an opportunity to see what we discussed last weekend in our research notes to Finom group members. If you're not a Finom group member, strongly encourage you to sign up for at least our contributor membership, which gives you access to all of our proprietary research and third-party research that goes out every week, our macro market research report, as well as our state of the market weekly video. If you want our investment ideas, what we're trading day in and day out, you can subscribe to our premium membership as well. And that'll give you all of our weekly research on top of our trade ideas and trade alerts. With that, this was our last weekend, October 8th. This was our market research notes that we outlined for our Finom group members. And then, as you can see in the title, it says not out of the woods yet. Even though last week, the major averages had a positive week, they ended a 4-week losing streak, if we're speaking of the S&P 500. But was that the bounce that would renew the uptrend? So in that report, we outlined this one very key super oversold condition that we'll talk about here in this week's free video. So with that, let's get her started. All right, so this chart right here, many of my ex-followers, not former followers, but ex, i.e. Twitter followers, had seen me post this a couple weeks ago, referring to the seasonally weak period associated with the pre-election year. And on average, in a pre-election year, the corrective wave that typically does start in the fall has bottomed on September 29th. And so far, that's about where we bottomed this particular pre-election year. Now, how did we start this journey, in the fall period? Well, we started with the top on July 31st, top in the S&P 500, year-to-date high, July 31st. And then as soon as August trading came about, well, the markets went into a corrective pattern. We understood that the markets were getting very oversold in late September, when the S&P 500, as identified in this chart right here, was trading 2 standard deviations below the 50-day moving average and below its lower Bollinger Band. Usually that is a very oversold condition, and it's setting up for some type of at least interim bounce in the market. But that was just one significant oversold condition that had arisen by September. As we moved or progressed forward in this seasonally weak period of the year, we had additional oversold conditions develop, like the percent of stocks trading above the 50-day moving average dropped below 15%. Historically, again, now we're getting compounding oversold conditions. It's got to start somewhere, right? But then it gets worse as we progressed through the latter innings of September, so to speak. It is the baseball playoffs, so there's your metaphor for the baseball season as well. So less than 15% of stocks trading above their 50-day moving average tells you markets are getting that much more oversold. Now, when you're looking at technicals, you still want to have the fundamentals kind of rolling through the back of your head. to help facilitate confidence in possibly buying the pullback in the markets, these oversold conditions. But even if you didn't have a fundamental basis to go off of, and all you were looking at were these technicals, we also have quantitative data to validate what the technical oversold conditions are suggesting. In other words, a buy the dip moment, and at some point this market would revert to its uptrend. This data right here, a quantitative study from the sentiment trader, validates these annotations here in this stochastic or breadth indicator, suggesting the market was oversold and now might be a good time to start buying. Once this signals less than 15% of stocks trading above their 50-day moving average, historically 6 months later, the market was up almost every time except for the great financial crisis in 2008. So 6 months later, a very high percent possibility the market will be positive from the signal date. 87% of the time it's higher. Even 2 months later, 2 months after this signal, this oversold signal, the market was higher 87% of the time. Moving forward, more oversold conditions. So we had a singular oversold condition, then it started to compound, and then sentiment really started to get bad. This is the bullish percent S&P 500 index. And when this bullish percent drops to the 30 level, that is typically where you want to start shopping. Now, on this particular date, October 3rd, that was before the market opened, I believe. We were at 33% on the bullish percent index for the S&P 500. That day, it did drop actually to like 29%. So it got washed out. Breadth was washing out. Sentiment was that much worse. And we got into the oversold condition for this particular sentiment indicator, if you will. Start shopping. Anything below 30 is typically a good place to be buying. So you had this singular oversold condition. Then we had compounding oversold conditions based on breadth metrics. Then we had sentiment oversold conditions. Ultimately, we had a confluence of these oversold conditions. Most of the time, that's a good thing, especially if the macro fundamentals are sound. And even more especially if earnings are inflecting higher, which we expect them to do here in the Q3 earnings season. However, and as we outlined to our Finom group members last weekend, there's oversold and then there's super oversold. Again, this is what we alerted our Finom group members to last Sunday. Now, what is this super oversold condition? This is developed by the Lighthole group. And the definition is, as I'll read right here, the latest leg down intra-week, last week, pushed a short-term breadth oscillator into the territory deemed super oversold. Specifically, on October 3rd, the 10-day average of net advances for the S&P 500 undercut the critical 150 threshold. In the table above from the Lighthole group, we can determine that after such a super oversold condition, even when the market bounces, Paige, you're going to don't want to miss this, folks. Even when the market bounces, it typically undercuts the prior low within 20 days. Data goes back to 1998. There's been a good 20 occurrences. Again, here's the super oversold reading of 10-day net advances is minus 150. Typically, you do get a bounce, but that bounce is undercut within 20 days. That's the average. What do we know about averages? Certainly using the average number of days is really just setting a model for expectations. Okay, but when we look at the actual data, additional number of days to the subsequent S&P 500 low, meaning after the bounce off of the super oversold condition, about 20 days later is the average. But there's a lot of, here it was the day. Like the low was that particular day. 0 day later, you made another low. 5 days later, you made a low. 1 day later, or the next trading day, was the ultimate low. 3 days later, there's a lot of single digits. More like 1 week later, many times did you make the ultimate low. And you might be saying to yourself, but last week was the low set, 42.29 in the S&P 500. And we've bounced since then. We're in that window, folks. We are still in this 20-day average window that we could still potentially make another low. Who knows? CPI today, as I highlighted at the beginning of our video here, PPI came out yesterday, hotter than expected. That might lend itself to a hotter than expected consumer price index report. Not making any predictions here, just saying we need to be open-minded to these possibilities. Now, while this does seem like bad news because we had a super oversold condition and usually the low was not made, you get the bounce and you make another low. Usually, again, to reiterate, sometimes it was the absolute low on that day, absolute low. A day later was the low. But here's the good news. With this bounce, right, we're up 4 days in a row for the S&P 500, I think 5 days in a row for the small cap Russell 2000. We can exonerate this super oversold condition if the net advancers gets to an interim overbought level of 100. So the 10-day net advances gets to a level of 100 from 150, negative 150, to a positive 100, we can exonerate this study. As of yesterday's close, where is it? The 10-day net advancers, 61. We are almost there, folks. Today's CPI report may be the deciding factor between whether or not the low was set on October 3rd, or we're going to undercut the low. Market needs a catalyst, right? It's one thing to bounce from these oversold and super oversold conditions, but many a time, market needs a catalyst to offset the super oversold condition. All right, so moving on from there. There is good news, when you get these oversold conditions. The good news is that you can possibly set up a Zweig breadth thrust, especially if the bounce is that severe. You can set up a Zweig breadth thrust. We've already had a Zweig breadth thrust fire this year on March 31st. This is still in the works. This signal is still playing out. As you can see here, 6 months after Zweig breadth thrust, the market has never been negative. All positive results. Average return 6 months later, 17%. So for March 31st, I believe that would take us to March, April, May, June, July, August, September, right? The market should have been positive from the signal date. The signal date price or closing value of the S&P 500 was 4109. Have we stayed above 4109 6 months later? Yes. Again, last week, the corrective low was 42.29. Even ending September, we were above 41.09. Good news again, 12 months later, after a Zweig breadth thrust, the market has never been lower than the signal date. Signal date again, 41.09. The average return is 24%, 12 months forward of the signal date. Now, why am I mentioning the Zweig breadth thrust? It's because we are on Zweig breadth thrust watch. It did signal, and one of the signals that you're looking for is breadth to drop below negative 20 there, which it did on October 3rd. the Zweig breadth thrust is fired officially if the total net New York Stock Exchange advancers gets above 0.61 10 trading days later. As you can see, we are above that. We are above that right now. But it has to be on that 10th trading day. From the signal date, 10 trading days later. So on October 17th, if we are above 0.61, we will have another Zweig breadth thrust fire here in calendar year 2023. Why is that so significant? We've never had two Zweig breadth thrusts. Well, I'm sorry, I apologize. We've only had it happen once, where the Zweig breadth thrust fired twice in a calendar year. Twice. 1962. So very significant, folks, very significant. All right, from a fundamental perspective, right? We do fundamentals, we do quantitative, and we do technical analysis here at Finom Group. One of the things that we talked about last year in October, this is before the market bottom. For those of you who know your market history, you know the market bottomed October, on a closing basis, October 12th of 2022. But the NOPE index, which is a measure of manufacturing here in the United States, spiked, right? We get the ISM manufacturing index. We would have gotten it in November for the month of October and October for the month of September. But it spiked for the month of September. The NOPE index essentially subtracts new orders from price. And that gives us a better indication on the inflationary aspects of the manufacturing index, what the influence has been. What I have been saying for quite some time is that this has not been a manufacturing recession of volume or transactions, but rather price. And when we saw the disinflationary impact in the ISM manufacturing reading for that particular month, the prices paid component within the ISM index had dropped sharply. And that gave us a spike in the NOPE index. Remember, NOPE, you subtract new orders from the prices paid. So if prices paid go like this, the NOPE index is, even if the new orders are steady, is going to spike. The NOPE index will spike. And that's what happened. They're usually a good sign. If the NOPE index gets above zero, the forward S&P 500 returns over the next 12 months average about 14%. It looks like history is repeating, folks. This was a fantastic signal. And again, this is developed by Jim Paulson of the Lightholt Group, who had retired. We've been tracking the NOPE index ever since, and it is still above zero. Fits and starts, don't get me wrong, but still above zero as of last month's reading. Now, we can also validate what we are hypothesizing over with respect to the manufacturing recession being more of a price disinflation component than actual volume in transactions and manufacturing power. We know as a whole, the US manufacturing is in a boom, but that boom is mainly centered on construction materials and electronics equipment, i.e. the Infrastructure Act. You have a lot of new housing starts, but we also have the CHIP Act, the CHIPS Act, i.e. electronics equipment. We can validate, the good side of the manufacturing equation starting to lift off here in the second half of the year based on what's going on with rail traffic. And as we can see, rail traffic, week over week, and for the last 4 weeks, has been moving higher. It's been expanding again. And this has been something that has been absent this year's expansion or GDP expansion cycle. So we've seen 4 straight weeks, but probably what's most compelling here is that the total intermodal units which is an indicator of shipments, mostly of consumer products, goods, it continues to increase 2.5% week over week. And again, that's how we can, validate that the ISM manufacturing, even though it's still below 50, which signals contraction territory, it's probably volumetrically growing. But the price component, the disinflationary component, is weighing on the survey overall, the overall survey. Now, here's the other funny thing that we've talked about for several months here at Finom Group. We've always wondered how these banks are measuring excess savings. Like, how do you know exactly what's excess savings? Is it just a standard deviation above the pre-pandemic level, what you're seeing in, clients' bank accounts, savings, money markets, CDs, and things like that? Or is it something else? What we have heard over the last couple of months from the banking institutions, JP Morgan, Wells Fargo, UBS, Bank of America, is that excess savings has dwindled down to nothing. There's no more excess savings. And I've said to myself, again, how can that be? And how are you guys measuring this? Because when I look at demand deposits, while they are coming off of their highs, you're still talking about demand deposits that are at record levels. I mean, look at this, folks. It's ridiculous. And you're telling me that excess savings has dwindled down to nothing, right? Which has been promoted throughout Twitter, and you hear it on the financial media. It's one of the headwinds or bricks in the wall of worry that we constantly hear on Bloomberg, CNBC, Yahoo Finance, so on and so forth. But my questioning of this metric in the past has now been validated. Just this week, JP Morgan's team has revised their understanding of excess savings, where it stands at now here in 2023. Excess savings is revised higher. After zero, after they said it was zero, they've revised it higher by 800 billion following the economic revisions to 1.2 trillion. At the current pace, this will deplete sometime in 2024. See, I think they're owning up to the fact that they don't get it. Sometime in 2024, now it'll be gone. Right. But anyways, this has been a favorite talking point of economic pundits and perma bears, over the last couple of months. There's no more excess savings. The consumer's tapped, as they've been saying. Well, now we see that there's a lot more excess savings. But really, my go-to is demand deposits. Keep track of this. You'll be fine. You can exonerate this nonsense from the financial media. It's nice to see Carson Research's Ryan Dietrich is also validating the same thing. About $800 billion in household excess savings. So with that, we've got an interesting day on tap, folks. We got a very key piece of economic data coming out, 8:30 Eastern time, the Consumer Price Index. We'll see if this uptrend can survive the whole of the week and this particular piece of economic data. With that being said, happy trading and join us here at Finom Group. Don't miss this weekend's macro market research report.